Okay, well, let's rock and roll. It's 11 o'clock New York time. Let's get started. Hold on, let me just move out this volume thing. Okay. All right. Welcome to BK Forex, money management for day trading FX. As always, trading foreign exchange or margin carries a high level of risk and every simple for all investors. I ask you to read this disclaimer very carefully to understand all the such trading on margin and to seek advice from an independent financial advisor if you have any doubts. So this is going to be a very informal session. And I ask you guys to ask me questions all the way throughout the session. I'm happy to do a Q&A about what I'm going to be talking about. I just sat through actually Dirk Du Toît session to hear what he has to say, and he had a lot of very interesting things to say. Some of which I agree with, and quite a lot of them which I disagree with, simply because of the topic that I'm going to be talking about today, which is day trading, and that's going to be the critical essence of my lessons from the School of Hard Knocks of money management. Let me first start by talking about the difference between day trading and position trading in FX. I think can describe what I have in mind much better visually than I can verbally. So here's the Great British Pound, right? It is incredibly attractive. It is very, very seductive to say, you know, if you really position trade, you could have sold here at the beginning of the year and covered here, you know, middle of the year. And look at this. You had a 1,200, 2,000, 5,000, 10 million, 5 trillion, 7 quadrillion pip trade, right? And it looks beautiful on a chart in the past. But I guarantee you, well, I don't guarantee you, I can't guarantee anything. The essence of my first conversation about trading is that you can guarantee nothing. And the thing that you can guarantee the least is how the future is going to turn out. The longer you trade, that is, the longer your time frame, I'm going to trade for a 500-point move. I'm going to trade for a 1,000-point move. The less likely you're going to be correct in figuring out which 500 points are going to happen. You know, it's extraordinarily difficult to project. You know, Yogi Berra once said, "Predicting is hard, especially about the future." And it was a very funny but very accurate statement. It is extremely difficult to figure out the forward movement of prices. Let's just take right now, and let me give you the current market analysis of where we stand, right? So here's the Great British Pound. The UK economy is doing relatively well. It's actually outperforming everybody in G7, as is evidenced by the fact that you've had already a big rally in cable, right? This growth in the UK economy is creating an assumption in the marketplace that the Bank of England is going to have to tighten monetary policy quicker than they expect. Blah, 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 so on and so forth. And you could have a long-term view that pound goes to 170, 175. That could be one way of playing it. The other way is you could say all of the UK economy has basically been driven by two things. Massive bubble in London real estate market, huge amount of quantitative easing that helped create lots and lots of rallies in the financial markets. And since 99% of UK economy is basically financial services, we've had this big recovery in the financial services. The moment we have a 10% correction in the stock market, the UK economy is going to go in the gutter, and cable goes to 5,300, right? So you could basically create both situations both ways. Let's take a look at the euro. And euro right now trading very nicely. Oh, sorry, it's not the euro. Sorry about this. Here's euro. Without the, let me get rid of the indicators. You know, one way you can look at the euro and say, hey, European economy is in the dumps. France is on the verge of becoming Italy. European policymakers are talking about quantitative easing, negative interest rates, printing their way out because they see that they've basically created deflation, and they're afraid that they're basically creating the lost decade the Japanese have enjoyed, right? Or you could say, hey, Europe went through the financial crisis with making major adjustments. Its banks are in much better shape. The ECB has the best balance sheet of all the major central banks. And now that the global recovery is starting to take shape, finally, Europeans may actually begin to see some growth. And the moment they start to see some growth, that's actually going to be positive for the euro, and the euro goes to back up to 38 versus back down to 130s. Point being is, at any given moment in time, I can make a very credible case for going up or for going down, and it is incredibly difficult. I mean, the bottom line is, if you say euro goes to 140, and it does go to 140, it's not because you're good. It's because you're lucky, right? And so, Dirk talked about the fact that currency prices tend to be random, right? Well, I'll share with you something very interesting that I think is really interesting for those of you who think, oh, I'm an investor, I'm not a trader. Long time ago, I visited a hedge fund in New York, run by a bunch of very, very smart Russians, actually, who had done tremendous. I mean, they had more computers in the Pentagon inside the hedge fund. They were very quantitatively oriented, and they've done tremendous amount of analysis on currency prices. And here's what they found out. And this is what I think is fascinating about this discovery. They found out that within 24 hours, your ability to predict currency prices forward at any given time, in other words, pick anywhere on the chart, over here, over here, over here, my ability to predict 24 hours forward degrades by 50%. By 48 hours, it degrades by 70%, and by 72 hours, it's essentially random. What that means is, the longer time frame you try to predict currency movements, the more of a guess you're making. You have literally zero chance of being scientifically, statistically accurate in your prediction. The only reason why money managers look so smart is because you have the 1 out of 1,000 idiots that is actually correct on his prediction. And so he, displays his prediction and his power of analysis. And then, of course, his predictions the next time failed miserably. This, by the way, just another interesting and I think a fascinating aspect. Never, ever, ever invest into a guy that's making money. I know that sounds crazy, and that's exactly what everybody does, and it's exactly why everybody loses. You know why? Because you're doing the exact same thing as buying the top or selling the bottom. Generally, 90% of the guy's performance is due to luck, and you're just buying the top of the luck factor when you're investing into a money manager. The single best time to invest into a money manager is when he's losing a ton of money and everybody is deserting him. Because his turn assuming his process is pretty good, and he's just simply experiencing a bad drawdown of his strategy, it is the single greatest time. In fact, in my opinion, it's much better, it's much more intelligent to invest into dips in drawdown of money managers than it is to invest into dips and drawdown in currencies. But anyways, that being as is. Is everybody hearing me okay? Somebody's saying that they can't hear me. I just want to make sure sound is okay. Sound is good? Okay. So, if predicting the future is effectively a throw of the dice, it's effectively, we know that 48 hours forward on any currency chart, pure randomness prevails, then the only modicum of control, the only area of control that we have is on a shorter time frame, right? And this is a time frame that I operate on. which is the intraday time frame, the daily time frame. And just for argument's sake, I'm just going to put in a 5-minute chart. I don't care about time interval. I just simply want to talk about the fact that I'm trading intraday, right? But here's what I want to share with you. If you are trading on a day trading basis, right, where you have a little bit better control over your ability to forecast data. And let me give you an example of something we did in BK Forex last night. So BK Forex last night, we traded the RBA minutes. One of the things that we do is we like to trade news. We never trade news before the news. We never try to guess what the news will be. What we try and do is trade the reaction of the market to the news, because we feel that's one of the things that actually is handicappable. And so we have this setup. I don't want to share the setup with you, but we basically traded the news where we bought the market's reaction to RBA news. And it worked out, and it worked out not even due to this. It worked out right over here. We made the target over here. And, we've been trading this setup quite, consistently, for quite a long time. And it's generally, and of course, past performance not indicative of future results. Of course, trading Forex carries a high level of risk and everything, can work the other way. But generally over the last, 6 months where we've been trading it with good discipline and target, it's been about 80% accurate, right? But what does that mean? That means it's also 20% inaccurate. It means that, we lose money. And this is by far, of all the setups we trade, by far the highest probability setup that we have, right? So we still take losses in this setup at least 3 or 4 times a month. If we trade 20 times a month, we consider it to be an absolutely great month if we get stopped out 3 times or 4 times in a month. That's considered to be a great month for us. So this brings me back to, I think, the single most important thing of day trading the Forex market. If you are not willing to lose money every single day, sometimes for 5, 6, 7, 8, 9, 10 days in a row, if you are psychologically not able to lose money for 10 days in a row, don't bother trading. Because only 2 things will happen to you. 1, you'll quit before you ever make money back. 2, you will always try not to lose money. You will always try to win on every trade because you hate the idea of losing. And this is what will happen to you. Let's go back to that pound trade. I'm telling you this will happen to you even if it's never happened to you before, because I have seen it happen to everyone. Here's what's going to happen to you if you don't like taking losses. You are going to see this big sell-off on the pound. You're going to decide that this is a really ridiculous sell-off. You're going to buy the pound here. It's going to go down more. You're going to buy the pound more. It's going to rally, but not quite to your break-even point because you've been buying the pound all the way down. And you're going to say, no, I think it's going to rally all the way back up to even. And then it's going to come back down, and you're going to buy a little bit more, and then you're going to buy a little bit more, and maybe around over here, or maybe if you're super conservative with your margin, maybe around here, you will lose all your money. Now this will happen to you maybe a year after you start trading, a month after you start trading, 2 years after you start trading, or 3 years after you start trading. But if you do not want to take a stop loss, and you're trading a margin account, I will always bet against you. As a matter of fact, 100% of the Forex dealer model is they're betting on your ability not to be disciplined. They're betting on your fear of losing because they know they're guaranteed to win. The moment you are afraid to lose is the moment the dealer owns all your money, because all of it will get taken away by the market. So I want to repeat this over and over again, because I know a lot of people teach you, you don't really need to do stop losses. Stop losses create a lot of uncertainty. Stop losses create a lot of unnecessary loss. Stop losses are really for pussies. You need to average in and average cost your positions and stuff like that. There is something to be said about perhaps not putting every single, doing a single entry, single exit trade. It's a completely different conversation. But the much bigger issue is you will lose. You will lose 5, 6, 7, 10, 15 days in a row, a lot. And if you are not both financially and mentally prepared to do that, don't bother trading. I will own you. The market will own you. The dealer will own you. Everybody else who is prepared to stay for the long run will own you. So in many ways, money management, first and foremost, is a psychological acceptance of the reality of life, which is that you do not get to win every day. And if you want to win over a long period of time, you need to be able to stay every single day, take your losses, move on, and stay with your strategy. So you do have to be willing to lose. Jonas is saying that the essence of the last webinar was you got to be willing to lose. What I'm basically trying to say, and Dirk had some very good points. I'm not sort of really arguing with what he's got to say, but what I'm basically making a key point here is that on a short-term basis, first of all, if you're going to trade short-term, where you have sort of the highest probability of accuracy, ironically enough, your ability to forecast 100 trades forward is probably going to be a lot more accurate on a short-term basis than it would be on a longer-term basis. But on a short-term basis, if you're not prepared for this little flush, right? Boom. We explode to the upside because PBOC says they're going to diversify. They're going to basically make the financial markets in China much more attractive. We slip we slip all the way down. Boom. We start to rally, and then one of the ECB guys says, no, we're going to do more quantitative easing, and boom, we come back up, and then we come back up and down rally. If you're not willing to get stopped out 3 times in a row on this kind of noise, you cannot trade the currency market. It's just par for the course that market environments will create this kind of price action sometimes, and sometimes they'll create a really nice, smooth, trending price action, and you'll be able to trade momentum up and down. So the point is, when you add up this kind of environment against this kind of environment, over a long term, if you have a good strategy, and this is the critical thing, you have to have a strategy that tests positively over the good term. And this is actually, I think, the other essence of what a lot of people don't tell you. Money management cannot turn a bad strategy into a good one, a good strategy into a bad one. Good strategies or bad strategies are the only things that really can work for you. What money management does is it overlays the proper risk control. And in the best of money strategies, that let's say I have a money strategy that makes 1,000 pips a year. There will be a period maybe sometimes even 2 or 3 months worth of a period, where I will bleed 500 pips over a period of 5 months in that strategy. Is that a bad strategy? No, not at all. It's just simply bad market environment for that particular strategy. And as long as I control my risk, as long as I stop myself out continuously with discipline and control, I can preserve my capital, and the strategy, once the market environment turns to a more favorable structure for my strategy, will not only make back the pips, but make pips in excess of my initial investment and give me a total profit. Now, does that work all the time? Of course, it doesn't work all the time. But the point is that is really, really how things work in real life. What you see very often, and nothing makes me in many ways angrier, I think, than retail traders being seduced by this notion. What you see very often from a lot of people who claim they never take a loss, or they take, they do 100 successful trades in a row, is it's not that they're not taking losses. It's that they're not realizing losses. What they do is they'll buy the euro here, it slips, they'll hedge it, they'll sell the same euro here on a hedging basis. So now they've actually manufactured the loss. But now the euro rallies, and they may want to get rid of their long, and then sometimes the short comes in, and they're basically doing what's called an anti-volatility trade, which is where they sell the tops, buy the bottoms. That's working beautifully, again, until you get one single trend of 500 points with no retrades, and all of their money is lost. So they're masking the losses. I guess my central point that I want to make today is that if you are not going to lose, there is no point in having a conversation about money management. There is no magical formula that's going to make you win every single day. There's no magical formula that's going to grow your account every single month by a certain amount of pips without ever having a loss. And if you're not willing to withstand a drawdown, you will never experience the joy of profit. And more importantly, you will never be able to sustain a trading business. You'll have a really great experience for a couple of months because you've masked all your losses, and you'll think you're really brilliant, and then one day or in a period of 1 week, you'll wipe out your whole account. Now, I want to talk a little bit about risk and reward on a day trading basis, because I think here I kind of agree with a lot of people who are preceding me or going after me on all of this. The standard risk-reward ratio that everybody teaches you is 2 times risk, right? So for every 10 pips of risk, you try to make 20 pips. The problem is while that sounds incredibly intelligent, you always want to risk more money than you want to lose. In real life, the markets are incredibly efficient, and they almost never give you the opportunity to make 2 times your money more than, this is the critical thing, more than 20 or 30% of the time. Sure, 1 out of 5 times you may be able to stumble into a trade that gives you 2-to-1 risk-reward ratio. But the irony of the whole thing is if you test a lot of strategies are going to be net negative on a 2-to-1 risk-reward ratio, but maybe net positive on a 1.5 to 1 the other way, where you risk 30 pips to make 20 pips. And the reason why is because this kind of crap happens all the time. Markets rarely go in a vertical move forward. They always do this little juke dance. They go up, they go down, they go up, they go down. They try to shake you out of a trade before they recover. And you have to give yourself generally more room for your stop losses than the room for your take profits. The flip side of it is they never go far enough many times. The point is that when you're day trading, you want lots of high frequency trades. They never go far enough into your target to make 2-to-1 target, and they never and they always go farther in the retrace mode than the 1-to-2 target ratio. So the flip side of using negative risk reward ratios is that it can be very very unattractive if you lose your accuracy. So in the setup that I showed you a little bit earlier, where we traded the Aussie dollar, this is a new setup that requires us to be 80% accurate in order to have a consistent winning profit. That is an incredibly big burden, and we trade this very selectively. This is not a setup that we trade 100 times a month. This is a setup that we trade maybe 15 times a month in very specific situations, precisely because the more accurate you need to be, the more selective you need to be in your setup, right? On the other hand, I have a setup that I trade right now very happily that trades 1-to-1. It trades 30 pips forward, 30 pips stop. And that setup trades insane. Like right now, since the start of this week, it's already done 14 trades, right? And here's the thing about that particular setup that I think is interesting. Most of the time, the winners, losers offset themselves, right? It's a winner, losers, winners. So you're basically not making any money at all. Occasionally you'll get a couple losers in a row, so maybe you're down 30 pips, and maybe you're down 50 pips occasionally. But when the market structure, is favorable to this setup, which is a momentum-based setup, then you get 2, 3, 4 runs of positive move. And remember, all you need is like one run like that a week, where you have, let's say, 3 winners to 1 loser, and everything else is just sets itself off, and you have a net positive week. So a setup that is highly active needs, as close as possible, even money rules, because it's not selective. A setup that is highly selective can have a higher inverse ratio of risk to reward. And those two things, I think, are critical to understand the basic dynamics of how the markets trade. Now, there are basically 2 ways to manage a trade. There is let's just go back to the euro, because that's our, prototypical trade. There's basically, I'm just show you. Okay. Let me just show you this. Okay, so single entry, single exit. I'm going to get long here on a fresh break of new highs I'm just going to create, I'm going to manufacture a bogus trade, right? With a stop right below the lows over here. I'm going to get low over here, and I'm going to do a 1-to-1 risk reward ratio. So this is like a 20 point stop, 20 point target, right? I'm going to give myself a 20 point target, boom, boom, boom. That's my single, 1 win, 1 loss. If I have more winners than losers, then I have a net positive setup. That's a classic structure, and I personally traded that way for a whole bunch of reasons. The second way of trading something is to say no. I'm not very good at picking the exact entries of my setup, and what I'm going to do is I'm going to, here's the euro going to fresh highs at 35. I'm going to be a buyer over here. Just humor me on what I'm trying to do here. But you say, I'm willing to, I may be wrong on this breakout, but I'm willing to, let's say, hold it to below 34, the lows of the day here, below 34.75. I'm going to buy down, I'm going to buy every 20 pips down to get myself into a good average cost of my position. So I buy here, I buy here, I buy here, I buy here. My ultimate stop is over here. If I'm correct and the euro goes up, then I'm going to be correct, right? Now, the advantage of this kind of setup is obvious. You don't have to be right. You can be wrong 2 or 3 times in a row, and you could still come out a winner. That's a very, very seductive, really, really attractive proposition to a lot of traders. People hate getting stopped. Like, I got stopped out once, twice, 3 times today. People hate that. Like, mentally, you hate getting stopped out 3 times when the euro didn't do anything, right? So it's really, really, really attractive to say, I'm going to buy here, buy here, buy here. And then, it rallies back up and boom, I've made all my money. And that works. That works like, 8, 9 times out of 10. But here's the problem with this setup. Here's the danger of this particular structure. And that's why I don't do it. What am I going to buy? Am I buying equal amounts of currency? Okay, so if I'm buying equal amounts of currency, I buy here, I buy here, I buy here. What have I done? I've done 1 size, 2 size, 3 size, 4 size. Now my position is 4 times the position that I had when I traded single entry, single exit, right? And let's say I stop out over here. So 4 times, and let's say my original risk was 20 points, right? But now I've put in 4 positions, and I have another, and I'm going to risk, another 20 points in there. Now if I'm wrong, in this case I'm not wrong, but I will be wrong. Trust me, I will be wrong. I will have lost 80 points. So in one single trade, I will have lost 80 points, right? Let's compare that to my churn over here. I traded once, get stopped out, minus 20. I traded once where I got stopped out, minus 20. I got traded once, I got stopped out, minus 20. So now I've lost only 60 points. It looks horrible that I got stopped out 3 times. But on an apples-to-apples comparison, I've actually lost less money by being stopped out more than by trying to add on to a position and then eventually getting stopped out. And I've given you a very, very favorable example of dollar cost averaging. In real life, one bad trade, when you do multiple entries, single exit or multiple entries, multiple exit, one bad trade meaning that, that every single one of your positions gets stopped out is probably worth about 20 bad single entry trades. In other words, you're going to lose 20 times the amount of money on one bad trade of averaging in versus losing 20 small little stop outs that you have over here. It doesn't seem that way because in the immediate term, it's like heroin. Oh, it feels so good, because you're never taking a loss. But the reality is, you are basically pumping up your account for a major brain artery blowout. That's really what happens, and that's why this kind of a structure is not one I trade anymore. I would rather take my pain. I'd rather take my slaps by the market right there, right now, real time, and move on, than to delay my fear. Because remember, all you're doing here is just delaying your fear. You're delaying your fear. And like I said, the more you delay, the more the market owns you. And, you may escape once, you may escape twice, you may escape 3 times, but in the 4th or the 5th time, you're going to have that minus 20x loss. And everything you've built up to then, and more so, is going to go down the tube. So I would rather bleed 3, 5, 6, 7% of my account on these small losses than make 5, 10% of my account, continuously, and then have a minus 20% drop down in one single trade. And that's why I like doing single trade entry, single trade exit. I like losing quickly and losing often because I know where I stand. There's no bullshit. There's no bullshit at the end of the day on my account. It's clean. It's truly mark to the market. It's real money that I've either made or lost. And the problem with that is that it's not a pretty picture most of the day. The problem with that is that it's red more days than it is green. So that's the reality if you're going to day trade. If you day trade in the FX market. Now, the last thing that I just wanted to share with you is the mechanics of how to properly risk. And in this case, I really, really agree with I think a lot of other speakers are talking about. But I'm going to give you a very specific rules for how I trade. I basically risk 30 pips to 25 pips. Let's just argument's sake, I risk 25 pips on a trade, right? What does that mean in terms of how much risk I am willing to assume per trade on my account? If I'm risking 25 pips, that's 0.25%. I am never willing to lose more than 1 to 1.5% of my account. So on any given trade. So that means that every single trade I make is never more than 4 times my equity. So if I have 25,000 in the account, I will never trade more than 100,000 euros on a 25 pip stop loss. That sounds like an incredibly, probably surprising and conservative approach. And it is. Because what's my point? My point is not to try to make $10,000 on a single trade, which is almost never going to happen. My point is not to lose $10,000 on a single trade, which will happen very often if I don't use this kind of risk control. And I think that's the most important aspect of money management. Money management function is to preserve your capital at all costs, to be fully engaged in controlling your losses. There is nothing we can do about winners. Either the market, there's only 2 trades that you can make in the market. You can either buy breakouts and, in a trending market, breakouts will work, or you can sell tops and bottoms, and in a choppy market, that will work. When the market changes its structure, and you will never know because the only way you know is by start losing money, your strategy will fail because there's only 2 strategies. You either buy tops and bottoms or you sell tops and bottoms. That's it. There's nothing else that you can do as a trader. And the critical thing is, since you really cannot control what the market does, all you can do is try to control as much as possible your losses. You can't control your winners. You have to control your losses, and you have to stay in the market long enough so that your winners are given a chance to actualize themselves. That's a very, I'm giving you obviously a very simplistic overview of the theory, but that is basically the basic theory. That involves basically, of course, creating a strategy that makes sense, creating risk and reward ratios that make sense, creating entries and exits that make sense, blah, 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 all those things. The hard part of creating a strategy still stays with you. But the overarching philosophy is stay alive until you make profits. By going for broke, you will go broke. So that's pretty much it. That's the essence of what I got to tell you as far as the money management of day trading secrets. To summarize, I never want to risk more than 1% to 1.5% of my account, which means that if I'm trading 25 to 30 pips, I never want to be more levered than 4 to 5 times my size. I'm fully willing to take as many stop losses as necessary. Of course, I hate stop losses. Nobody likes to lose money, but I'm fully willing to take my stop losses. I never, ever, 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 ever lift my stop. Having blown out countless accounts, and lost lots of money doing that when I was kind of an amateur retail trader, I always take my stop losses. And I never take any single trade, any 10 trades, any 50 trades personally. When things are not working, it's not your fault. It's simply the structure of the market. Remember, there's only two trades you can make in the market. You either buy tops or you sell tops. And your job is just to figure out the best possible time for when you think the market is going to respond to your strategy. All strategies are just derivatives of those two ideas. So now I'm open to questions. Happy to answer anything you guys have, and we'll wrap it up from there. Ian is asking me a great question. Once you set your stop and limit, do you watch the trade or walk away? Of course I watch the trade, Ian. I have I have 9 screens in front of me. I watch every single trade I'm in. And, my trades sometimes go for hours, sometimes they go for minutes. Is it annoying to get stopped out, in 3 trades in a row? Of course it is. I tell you what really kind of helps. I have a lot of algos running around now. I have more than one type of strategy, and the diversification of strategy is really one of the things that kind of gives you the peace of mind. But my strategies are well tested, have gone through lots of different. I've traded them live. The other thing is you never really know how well you're going to do until you trade something live. And more importantly, you never really know until you've traded something live that's just not working in the market environment that you're in. You will only know that you can trade something if you can withstand the drawdowns that the strategy presents you. It's kind of like, you only know you can really run these strategies after you started losing money in them. It's really easy to run strategies when they're making money. It's really hard to run a strategy for 2 or 3 months that's losing money and dripping capital 2 or 3 months in a row, and stay with it, and then see it recover. That's the hard part. But that is really what's necessary if you want to have a long-term success. If I ever see a trade going against me, before I'm stopped out, do I exit early? No. Everything I trade these days is algorithmic, which means that it's been tested systematically. So I never give a damn about any single trade that I'm making because, first of all, sometimes if I exit early, maybe, yes, I save myself some pips. A lot of times the trade may turn around and go into profit. I never know. On any given trade, I never know if it's going to be a positive trade or a negative trade. The single most important thing you need to learn is to, once you have a system, let the system trade. That's why, I really recommend that you make something algorithmic and let a EA trade the system for you and you watch it instead of you trying to mentally, manually interrupt yourself continuously. Do I trade only the 5 or lower things? The 5-minute chart is nothing. I don't trade charts. I couldn't care less about time frames. I trade price action. I trade highs and lows. I trade price action. 5 minutes is just a convenient representation of price action. I just wanted to show you a short-term price action. One thing that Dirk said in his presentation that I think is very accurate is if you're looking at the market through a 5-minute chart, a 15-minute chart, a 30-minute chart, you're just looking through an artificial lens, okay? The market is not about charts. The market is about prices, okay? You could have, on a 5-minute chart, you could have a move like this. Where am I? You could have a 30, 40, 50-point move like this, or you could have a move like this. What does it tell you? Nothing. What really matters is price, not time. You don't get paid for time, right? You get paid on price. Any What is my favorite time frame? Again, I don't have a time frame. I don't use raincoat charts. I'm sorry, I'm not familiar with raincoat charts. Again, I don't care about charts. I don't care about indicators. I have a lot of algos that use indicators that have nothing to do with signals, but those indicators are there for completely different purposes than to give you signals. All indicators are derivations of price. All indicators, trading the market using indicators is like driving a car using your rear view mirror. You may make it for about 100 yards. Sometimes if you're on an empty highway, you may make it for a couple of days, but you will eventually hit a wall. You don't get paid for trading what happened. You get paid for trading what will happen. Somebody's asking, can we see what I see on how do my algos work? Join BK Forex, Boyke, and I'll be happy to show you how my algos work. Subscribe to my service, and I'll be happy to show you how my algos work. Okay, guys, we're coming up to the end. Final questions? Anything else I can ask you? I can answer. No? Well, I hope you guys enjoyed it. So let me just to recap the key points that I wanted to stress. Number one, if you're day trading, don't risk more than 1 to 1.5% on any given trade, which means that if you're using 25 to, and one of the things I sort of forgot, and I think this is very, very important, I don't think you can use a stop less than 25 pips. You can't use a stop less than 25 pips on a day trading basis as a retail trader and expect to have any chance of success. You have to have, the market is so volatile, the spreads are so wide, the necessity to kind of, let price do its thing and settle up is so great that you really have to have at least a 25 point to 30 point. I found that 30 points, if you think about this, 100 points is the average movement of the day. So I'm basically slicing a third of the day as my stop entry. That seems to work pretty well across all the major currency pairs. That's what I'm going to be risking. And I'm not going to risk more than 4 times my equity size. So 30 points times 4, basically 1.2% is where I want to be at every single trade that I'm making. It's a grind. I'm going to make 100 trades to make 50 points. That's the reality of how I do it. And if you're not kind of comfortable with that reality, if you want to make 2 trades to make 5,000 points, be my guest. I'll see all your money wind up in the market's pockets. Thanks a lot. Is there a site where the ATR can be found? ATR is available on every single currency. You can go to NetDania's charts and get the ATR. ATR is a very, very common indicator. I use physical stops. Great question. Somebody's saying, do I use physical stops? All of my stops are in my algorithms, and I use physical stops only. Never, ever, ever use mental stops. Mental stops is like mental masturbation. It's that's pretty much all it's good for. If you want to trade real, you got to use real stops. Okay, guys, thank you so much. Thank you for coming. And I'm sure we'll have all of this on record, and I'll post it on my thing. Everybody follow me at FX Flow, and everybody come see us at bkforex.com. Thanks again for everything. Talk to you later.